Adrian Cartland. I'm the principal of Cartland Law, a tax law firm in Adelaide, South Australia, and the creator of ALIRA, the Artificially Intelligent Legal Information Research Assistant. I'm here to talk about Bitcoins, blockchain, and other cryptocurrencies, and their legal and taxation effects. So, first of all, the thing to consider is the nature of Bitcoins and crypto, and what constitutes the property in there. So there are really three options. First of all, is the property the private key? Is the property the tokens that are newer to it? Is the property the property the wallet in which they are stored in? Now, first of all, from a legal perspective, I think that the only property in there is the private key, and that's property by way of being confidential information, and that confidential information then has rights that go up and down in value as you get more coins or decreasing coins and tokens that attach to that private key. Now, the tax office, the Australian Taxation Office, takes a different view. What they think is that together, all of those three things create some kind of generalized and non-specific asset. Now, I know that in section 108.5, the definition of a capital gains tax asset is set quite broadly, and so a capital gains tax asset isn't necessarily the same as what constitutes a property right, although there is typically overlap. And so, while I don't think they're necessarily correct, at least the view that we have to work with, unless you wish to challenge the tax office, is that somehow the tokens themselves are the assets. And so that is to say, in the view of the ATO, if you get a token, then you have received an asset. If you get one Bitcoin or one Ethereum, that is an asset that you have obtained. Now, how they got to that point is really by saying that people are purchasing these and they have some kind of economic value, therefore it must be an asset. So I don't think that that's necessarily correct at law. It is the view that they're taking, and it's the view you need to deal with for tax purposes, although quite different at law. So I'm going to make a comment about the legal nature of cryptocurrency, which are often described as smart contracts. I don't think that cryptocurrencies are a smart contract for law. I don't think they are. There is typically a contract at law behind most crypto, for the reason that the transactions are not legally binding, nor are they intended to be. There's no intention to create legal relations. So, let me say, if I was playing Space Invaders and I own the game, which is an asset, and then I get more points, and those points is very valuable to me. I want to get as many points as I can, get the highest score that I can in Space Invaders. And how I go up and down in points in Space Invaders will affect my worth of the game. I'm sure there is some inherent enjoyability in playing the game, but I want to get lots of points. Now, I would not say that playing that game and accumulating points is that there is any kind of legal relation. Even if I was playing a game against someone else on the other side of the world, and I'm trying to get points in there, and they're losing points, how are we intending to have some kind of contractual relationship? What we're intending to do is play according to this game, or play according to this program. And so that sure, the program itself might be valuable, but if there's a glitch in Space Invaders and all my points disappear, or if I'm playing Pong with someone on the other side of the world and suddenly there's an error in there that gives them 1 million points and me 0, I can't sue them. There's no contract to do this. And I think the same applies to cryptocurrency. Most smart contracts, unless they have something specifically that says we intend this to be a legal contract, where the smart contract takes up the whole of the rules that you are governed by, which is really, I think, the most interesting thing, and the most interesting proposition, is, but if you're doing that, you're playing entirely by the program, and which means that I don't think that there is intention to create legal relations. What you're intending to do is do something according to this program. And so the simplest smart contract is obviously Bitcoin, and the smart contract is that I will debit my account and credit yours. And we agree that when my account is debited, it is reduced, and your account is credited. Now, but what happens if there was a failure? Now, of course, we're going to say, no, a failure in this is very unlikely. But from the legal perspective, what really matters is is when the unlikely event happens. I literally had a client the other week transferred some minor crypto from one account to another, and there was some unspecified error, and they lost 30 grand worth of crypto. And so then we need to dispute this. And so if something goes along, if there is a contract between myself and someone else that is entirely put on a smart contract, is it the case that this is legally binding? I don't think so, unless you say, for example, Agrello seek to put a separate contract that says this is legally binding, and that if this fails, this is how we determine it. Now, it could be a simple code-based contract, but I think you typically don't have intention to create legal relations. And what this means then, this has a number of other effects from a tax timing perspective. So when you enter, for example, if a crypto is a capital gains tax asset, which of course it can be, if you're holding it on a capital account, then what will happen is the timing of you sell it, dispose of it, is either the earlier of when you enter into the contract or when you dispose of it, if there's no contract. So now this doesn't really matter unless you're transacting on the 30th of June at 11:30, and it takes an hour to process, and you say, oh well, if there's no smart contract, then it happens in the next financial year. But as we get into more advanced tokens that have a really complex set of rights that might take some time to execute, it will really matter whether there is an intention to create legal relations and when the time of the execution of that contract is. And so, if I say that in a year's time, I give you one Ethereum, and then in a year's time you'll give me 2 back. When is the time of me getting my 2 back? Is it now, when I enter the contract, or is it in a year's time, when I get them? So, in my view, that because there's no intention to create legal relations, it has some very significant difference impacts that people perhaps haven't considered. Now, so we have sort of 3 considerations. One, the legal implications, which then the legal nature of cryptocurrencies, which impacts on a whole bunch of others and feeds through to the way the tax office considers cryptocurrency. And 3, there is the overarching regulation. So the regulation of cryptocurrencies in Australia, the key things to consider is ASIC and AUSTRAC. So AUSTRAC tracks Australian money, or money in Australia, and is really concerned about counter-terrorism and anti-money laundering. And AUSTRAC say that if you're an exchange, you need to register with them and put into place certain money laundering, anti-money laundering, and counter-terrorism measures. So that's one. As soon as you become an exchange in Australia, you've got a bunch of regulation. Now, curiously, if you're an exchange, if you're with ASIC, ASIC will consider, are you a financial exchange? Now, a financial exchange will the financial exchange will depend on if you are trading financial products. If you are a financial exchange, then you'll have a huge regulatory burden, I think. Just like if you're the ASX. Now, financial products, it's going to be really interesting from an ASIC perspective. Do you have financial products? Do you have shares? Are you having derivatives? And so they think that your standard cryptos like Bitcoins, they're not shares. If I'm having an ICO of a token, that's not going to be hit with regulation, but from ASIC. But they will then look at the underlying rights and see how this fits in with their regulatory scheme. So, in a nutshell, if the value of your tokens in your crypto comes only from trading it with other people, so Bitcoin, the value of Bitcoin comes only because people use it as a medium of exchange or are speculating on its future value, in which case, if you have a token like that, you're fine. Now, if I have a token that will increase in value based on the profits of the company, now, whether it's because I'm going to derive revenue or because as the company becomes more profitable, there will be a reduction in the amount of tokens, perhaps which is akin to a capital buyback, or whether I get some additional rights. Then I might fall within the managed investment scheme. If I'm going to be getting if I have some kind of voting or control rights, if I have rights to winding up capital on the winding up of the company, if I have rights to some kind of dividends or ongoing payments, I might become shares, I might become some kind of financial security if I'm going to get payments. So it's when you move into something that is not a utility token, not used for purchasing other things, that is when you are going to hit a whole bunch of financial regulation. But if you have some more, what I'd say, classic crypto that is a token that is going to be used for purchasing your goods or services or tracking or have some kind of other utility, I think that Australia is relatively peaceful in its regulations. So now I'm going to talk about some tax issues that I don't think other people have fully realized. They are in the ATO's public rulings, but I don't think people have thought exactly how the ATO will apply them. So in Australia, crypto will typically be a capital gains tax asset if it is used and held for appreciation or for investment purposes. It's not a foreign currency. I actually think that's wrong. I do think that it is a currency. I think the tax office is wrong there, but it you're going to have to fight if you want to be considered a currency. It's also they initially said that you're going to have to pay GST. It's a disposal of an asset. It's a supply of an asset. However, we now have an express law that says there's no GST on crypto transactions, which is great. But I think something that's been massively overlooked is whether it is on income account or revenue account. Now, what does that mean? So if I have a tree, or I have a piece of land that and I have the tree to produce apples, or I have the land to hold and sell for rent and rent out, those are on capital account. What this means is if I hold it for 12 months time, before I dispose of it, I'm going to get a 50% capital gains tax reduction. And I'm using it as part of my business. Maybe I can use get the small business capital gains tax concessions. There are also a whole bunch of other capital gains tax rollovers and relief, and so the treatment of capital is generally more favourable in Australia, and the although if it's held within a company, it won't matter. It generally won't matter. Whereas, because companies, everything will be taxed at either 27.5% if you're a small company, or 30% if you're a larger company. And so, but what you'd want to do is anything that's held on capital account, you're going to want to hold individually or in a trust or a partnership or something else that's going to flow through, and you will receive usually discounted gains. Now, a revenue asset is something that, or perhaps some trading stock, is something that I hold that is for the purpose of selling. So if apples that come from the tree, they're trading stock. The rent that I receive from my house, that is revenue. Now, of course, if I'm in the business of cutting down forests to use as timber, then suddenly my tree is on revenue account. Now, if I'm a developer and the thing that I do is I make lots of houses and then sell them off, then my houses are on revenue account. Whether something is on revenue account will affect how it's taxed, and will also mean that the trading stock accounting rules will apply. And without going into too much detail of how this is, perhaps you need to so you might get a deduction for purchasing your trading stock immediately. You may have to bring it to account at the end of the year. So if you start off with 100 apples and you end up with 110 apples, you're going to, you have made profit in there that you're going to have to declare. If you purchase 50 apples, then suddenly you're going to get an immediate deduction for that. Whereas if I purchased 50 blocks of land to rent out, I don't get an immediate deduction for that. So here is the important point that I think that people in the crypto community, and in fact that the tax office, is not really at the front of their mind. I think that most people in the crypto community hold their crypto for speculative purposes. They buy it so that it will go up in value, and then they will sell it. That seems to me that the activities of most people that I meet is much more akin to a trader who holds it on a revenue account and trades it, than someone who is buying and holding for the long term. Now, some people do buy and hold for the long term. There's a couple of tax office private rulings where they have considered this, but the things where they have considered it have been very, very bland and obvious. Like, for example, someone mines at the beginning. They started mining early on, and they've just been holding it because it's really interesting, and they're going to hold it into the future, and they may sell it if it goes up, but they're not sure. If you are churning around, you're trading your crypto, you're buying into every ICO, and you expect it to go up, I think this is on revenue account. And that when you're disposing of it, you're making immediate income that's not discountable. So I would probably say 90 to 95% of people that I see in crypto are holding their crypto on revenue account. Now, maybe you can change that. Maybe you decide that now I'm suddenly become a hodler, and that you're not going to sell, under most circumstances. That somehow you're just going to wait for it to appreciate in value. Actually, having a change in purpose is a taxable event, and it has tax implications. So. There is there is a lot of people who have a lot of money invested in this, and I think most accountants and at least the initial stage of the ATO, I don't have this in the front of mind. I can tell you though that this is really just based on fundamental tax principles, and that this will, I think this will be something that will come to the forefront of tax disputes, whether people can get discounted gains, whether they have to, if they've suddenly had an increase in value of their trading stock, do they have to, and they haven't even disposed of it, do they have to pay tax on that? It can also make the accounting for things easier. If you just have trading stock, you just count it up at the end of the year instead of having to go, when did I purchase my trading stock? If it's a capital gains tax asset, you're going to say, when did I purchase it? How much money did I put in? Work out your cost base, how much it costs the assets, versus how much they're presently valued for. So there's it's not necessarily that it's terrible one way or bad the other. It is different, and I don't think this is something that people are very aware of. Now, actually, I've had some discussions with people who have gone, no, like crypto is somehow outside of government supervision, or it's difficult to track. Therefore, who cares? Now, when you have a ledger, which for many cases, perhaps not like Zcash or Monero or something, for most ledgers they are public, and so the only reason why the tax office has not totally reconciled it with with who owns this and what's happening with these transactions is because they haven't had time yet. Now, I can tell you that they are working on this, and in fact I spoke to a prosecutor recently, police prosecutor, who called cryptocurrency and Bitcoin prosecution futures, because they know that at some time, once they have mined all of the data that they can out of these public ledgers, they will find a whole bunch of naughty transactions that haven't been disclosed, people purchasing drugs or buying things, or even just not declaring their taxes, and they will get to it. And in the case of things like fraud or evasion, like tax fraud or evasion, which is like tax evasion, is at the simplest just not declaring it. Like, say, if I receive cash for doing a tradie job, that's just evasion. There is no time limit in which they can go back. So that the tax office, if they don't have the technology now, which they don't, but they're working on, they might in 2 years' time, or 5 years' time, or 10 years' time. And so not only, if you're picked up for evasion, you are going to get 100%, 50 to 100% penalties on the tax payable, plus interest at this presently about 14% a year. Now, so if it's picked up in 5 years' time, which is probably a reasonable time frame, like you're going to be paying many times over what you gained, and it will be picked up, and you might because you have to have some. It's almost inevitable that you have some kind of contact with, like, between your private key and the outside world. Now, if you just have a private key and you've just mined money, bitcoins, and you've never spent it on anything, well, it's pretty hard to track that. I admit that. But as soon as you start making payments, then you have some kind of contact with the outside world. I'm sure there's people who are much cleverer than I am who can think of ways of putting this through, but just remember, any transaction that you do, there will be someone potentially with unlimited time and resources trying to work and undo that. And particularly when you have large amounts of money, you are you are going to be very attractive. So I'd like to go on another point. $10,000. So $10,000 has a couple of it's relevant for a couple of reasons. One, if you are from a anti-money laundering point of view, like AusTrack, if you're making transactions over $10,000, then that needs to be reported to them, and they're going to track that, and they're going to want to analyze the transaction. Now, so the obligation there is on the exchange to provide that information. Now, $10,000 also has a relevance for tax. So if you have an asset that you have acquired for less than $10,000 and you use it for personal expenditure, then you don't have to pay capital gains tax on that. So let's break that down. So you've acquired it for less than $10,000. So maybe you're mining Bitcoin, in which case you've acquired it for $0, or perhaps the $0, although if you're mining, it's probably on revenue account. You're almost certainly running some kind of business of mining, in which case your mining equipment should be a business expense, and the Bitcoins that you receive will be on the trading account. The crypto you receive is on the trading account. If you're doing things in a business-like manner. There is actually a private ruling where the ATO considered this a couple of years ago, and someone was mining, but they had been mining for a hobby, and it was back in the early days, and ATO said like, no, you don't get a deduction for it, and we don't think it's on revenue account. You're holding it for the long term, and it's capital. But it was a very vanilla case, and it's very obviously capital because they're holding it. I would say the conduct of most people who are mining, they would be running a business. So you have so back to the $10,000. So you have obtained some kind of you've obtained your crypto. Perhaps you've bought it, and even if it's gone up in value and it's presently worth more than $10,000. So long as you're spending on personal things, then that's you're not going to pay capital gains tax on the disposal of those assets. Now, personal things is not buying more crypto. Personal things is your food shopping each weekend, your pizza, and your phone bills, and like unless you're living an extremely lavish lifestyle, which maybe you are if you're a Bitcoin billionaire, it's unlikely that you're going to make huge gains out of that. It's kind of cool, but it needs to be an asset that you've purchased, and one particular if you're spending your entire life, if you're making all of your profits for your lifestyle off crypto, and you can't say that I've purchased this in less than $10,000 lots. The tax office is going to say, you're funding your lifestyle of crypto. Sure, maybe you've got all these amounts that are worth less than $10,000, or they started off being less than that, or you're doing it in less than $10,000 transactions. Doesn't matter. It's all on revenue account. This is basically, so this is not supposed to be some great way of not ever paying tax. What it's meant is just to be to clear off people who get some crypto and they buy some stuff, and it just puts you out of the tax and regulatory system. So if you're legitimately using crypto to buy small amounts of things, buy overseas, you buy something that goes up in value, and you buy the new motorbike, you're fine. If you're buying Porsches, probably have a chat with your tax advisor. So I'm going to be discussing this at the Blockchain and Bitcoin conference in Sydney on Tuesday, the 29th, and I also I've got a list of questions, but I'm aware that I've been talking for a while. So I have been asked about using blockchain data in legal disputes in Australia. No. One interesting point was there are a number of privacy laws, like if you could be ordered to take down material, if it is immutably on the blockchain, you could be in some trouble. I know there's been some long-term hoaxes in crypto about there being porn on the blockchain, and that, but as far as I understand, that's just fake news. And but the question does remain that what happens if someone puts something terrible or offensive? Can it be removed? Well, no, and yeah, that's a problem. One thing that I think is really interesting from a legal perspective about crypto is that for a distributed system like Bitcoin, when I say that it's not a legal contract, I actually see that as a positive thing. I see it as being entirely outside of the legal system, and so smart contracts in that way can offer actual competition to our entire legal system. So now this isn't the first time this has happened. Like the courts of common law and chancery in our jurisdictions have competed with each other. The courts of chancery, which came out of the Church of England, they would make in personam judgments of things of, they would be the conscience, things they thought were fair, and the courts of the common law would follow black letter rules and say, this is what, like you can only have rights to land if you are the legal owner, and but if they say knights have gone away on the crusade and they gave their land to their best friend to hold for the benefit of their children, there's not any way that you can write that down. So the courts of chancery would say you need to, they're going to recognize a trust back then called a use, for the use of someone else, the benefit of someone else. So there was actually a lot of competition between these courts. There is presently competition between different jurisdictions. Jurisdictions want to be the jurisdiction in which disputes are in, and crypto can be a competitor to the courts entirely, because, say, unlike a bank, the courts can make judgments that are enforceable against a bank. They could say, we're going to injunct you from doing something, or we're going to make an order that you transfer money over here or do that. For a distributed system, there is no one there that you can make an order against. There is no way of enforcing it. You can only make enforcements against particular people. Now, so if you're a person and you've got some Bitcoin and you had an ordinary contract with someone to transfer them some Bitcoin and you didn't, then sure, you can have contractual remedies against you. But if you're not I'm not saying that as a person, if you're physically somewhere, there's no legal redress against you. But for contracts that are conducted entirely electronically, that may have a challenge to the fundamental rule of law and compete against the courts themselves. And so on that sort of hypothetical and interesting note, I'm going to leave and I'm going to talk about these and any other questions that people have, and I look forward to seeing you on the Bitcoin and Blockchain Conference in Sydney on the 29th of June, 29th of May. Cool, thank you, bye.